technical analysis, it enables you to identify trends and patterns within charts to make predictions about future price movements. But what exactly should you be searching for? Let's take a look at some of the main chart features traders use as signals. A support level is the point at which a market that's falling halts its declines and turns around. A resistance level, on the other hand, is where a rising market reverses and begins to fall. The more times the price reaches a support or resistance level, but fails to go through it, the stronger that level is said to be. Patterns can signal that a breakout, a significant move beyond one of these established levels, is about to occur, helping traders to time their trades. A double top forms where two successive high moves are sold into, creating two peaks on the chart and a low point called a neckline in the middle. This can indicate that the uptrend has finished and a reversal is likely. A double bottom is the opposite, so may indicate that a bullish trend reversal is on the way. Generally, it's best to wait until the price has broken the neckline before placing a trade, as another type of pattern, a triple top or bottom, can sometimes form. A head and shoulders pattern is very similar to a triple top. It forms when the middle peak, the head, is slightly higher than the shoulders. This pattern often indicates that a bearish trend reversal is on the way, while its cousin, the inverse head and shoulder pattern, can signal a bullish move. Another way to forecast potential market movements is by using trend lines to create channels. One line joins the peaks, the other the troughs. The shape these lines create can be an indicator of future price movements. An ascending triangle forms when there's a series of higher troughs moving towards a strong level of horizontal resistance. It usually signals that the price will move higher. With a descending triangle, a series of successively lower peaks move towards a strong level of horizontal support, suggesting the price will move lower. Where the lines converge to create a symmetrical triangle, it's likely the price will continue to move with the overall trend once that breakout occurs. Another type of pattern, a wedge, forms where a market's price starts to narrow between two sloping trend lines. A rising wedge is formed where there are two upwardly slanted lines, with the price likely to push lower once the pattern has fully developed. A falling wedge, on the other hand, is where there are two downwardly sloping lines. It indicates that the price is likely to rise. Remember, chart patterns are just signals of where a price might go in the future. They are not guaranteed. So it's always sensible to wait until the direction of a move has been established before placing your trade. To learn more about chart patterns, including those formed by candlesticks, join IG Academy today. It's completely free and gives you access to short, step-by-step courses and webinars on a wide range of trading topics.